Using the multi-head attention mechanism to manage a portfolio is an innovative approach that leverages advanced machine learning techniques, particularly from the field of deep learning. Multi-head attention, MHA, which is a key component of transformer architectures, can be applied in financial contexts to capture complex relationships between various assets, market conditions, and other factors influencing portfolio performance. Here's how you could use multi-head attention for portfolio management. Number 1. Understanding multi-head attention. Multi-head attention allows a model to focus on different parts of the input simultaneously by computing attention scores across multiple heads. Each head learns to attend to different aspects of the data, allowing the model to capture diverse patterns and dependencies. In portfolio management, MHA can help identify relationships between different assets in your portfolio, historical price movements and macroeconomic indicators, market sentiment and news articles, risk factors and volatility measures. Number 2. Steps to apply multi-head attention mechanism. Step 1. Data collection and pre-processing. Asset data. Collect historical price data, e.g., daily closing prices, for all assets in your portfolio. You may also include technical indicators, e.g., moving averages, RSI, and fundamental data, e.g., earnings reports. Market indicators. Gather macroeconomic data, e.g., interest rates, inflation, and market sentiment data, e.g., news sentiment, social media trends. Risk factors. Include risk metrics such as volatility, beta, and correlations between assets. Normalize or standardize the data to ensure consistency across features. Step 2. Feature representation. Represent each asset's time series data as a sequence of vectors. For example, if you have daily price data, each day's data can be represented as a vector containing prices, volume, and other relevant features. Similarly, represent external factors, e.g., macroeconomic indicators, news sentiment, as sequences or embeddings. Step 3. Input embedding. Pass the preprocessed data through an embedding layer or a dense neural network to create fixed-size representations for each asset and each time step. For instance, each asset's price history could be converted into an embedding vector that captures its temporal dynamics. Step 4. Multi-head attention layer. Use the multi-head attention mechanism to compute attention scores between different assets and time steps. The attention mechanism will allow the model to weigh the importance of different assets relative to each other at different points in time. For example, it might learn that during periods of high volatility, certain assets are more influential than others. Each attention head focuses on different aspects of the data, such as short-term price movements, long-term trends, or correlations with external factors. Step 5. Portfolio allocation decision. After applying multi-head attention, the model outputs a weighted representation of the assets. These weights can be interpreted as the relative importance or contribution of each asset to the portfolio. Use these weights to determine the optimal allocation of capital across assets. For example, if the attention mechanism assigns higher weights to certain assets, you may allocate more capital to those assets. Alternatively, you can pass the output of the attention layer through additional layers, e.g., fully connected layers, to generate specific portfolio weights or trading signals. Step 6. Optimization and risk management. Incorporate constraints such as transaction costs, liquidity, and risk tolerance into the optimization process. Use reinforcement learning or optimization algorithms, e.g., Markowitz mean variance optimization, to fine-tune the portfolio weights based on the attention-based predictions. Regularly rebalance the portfolio based on new data and updated attention scores. Number 3. Benefits of using multi-head attention for portfolio management. Capturing complex relationships. MHA can capture nonlinear relationships between assets and external factors, which traditional models like mean variance optimization might miss. Dynamic adaptation. The attention mechanism can dynamically adjust to changing market conditions, allowing the model to adapt to new information quickly. Interpretability. While deep learning models are often considered black boxes, attention mechanisms provide some interpretability by showing which assets or factors the model is focusing on at any given time. Number 4. Example use case. Asset allocation with multi-head attention. Let's say you have a portfolio of 10 stocks and you want to allocate capital dynamically based on market conditions. Input. You feed the model historical price data for each stock, along with macroeconomic indicators, e.g., interest rates, GDP growth, and sentiment data, e.g., news headlines. Attention mechanism. The multi-head attention mechanism computes attention scores between different stocks and time steps. It might learn that during periods of economic uncertainty, defensive stocks, e.g., utilities, receive higher attention, while during bull markets, growth stocks, e.g., tech, are prioritized. Output. Based on the attention scores, the model suggests a portfolio allocation where more capital is allocated to defensive stocks during uncertain times and to growth stocks during favorable market conditions. Number 5. Challenges and considerations. Data quality. The performance of the model heavily depends on the quality and quantity of data. Ensure that you have sufficient historical data and relevant features. Overfitting. Deep learning models, including those using attention mechanisms, can overfit to historical data. Use regularization techniques and cross-validation to mitigate this risk. Interpretability. While attention mechanisms provide some interpretability, they are still complex models. Be cautious when interpreting the results, especially in high-stakes financial applications. Computational complexity. Training models with multi-head attention can be computationally expensive, especially for large portfolios or high-frequency trading. Number 6. Conclusion. The multi-head attention mechanism offers a powerful way to model complex relationships between assets and external factors in portfolio management. By leveraging attention, you can build dynamic, adaptive portfolio strategies that respond to changing market conditions. However, it's important to carefully design and validate the model, considering both the benefits and challenges of using deep learning in finance.